Hey guys, Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sidney, Ohio. This is another episode of the Mortgage Guy podcast, and this is the one you're going to hear about USDA updates and announcements. So I was super excited about it. I found out about it the other day. USDA made an exciting announcement in regards to debt ratios, and we're going to kind of cover what that means. But the ratio on the housing expense ratio went from 29 to 34%. Now, when I found out about it on this call, I was super excited. Everybody else was just kind of looking at me and staring at me. A little background, USDA is my favorite program. If you've watched any of my prior podcasts, and productivity levels for USDA for me, I'm actually the top USDA producer in the state and number 6 in the country between units and volume. So I love this program, and it helps so many home buyers. Background again on the product. Zero money down, very low PMI, is very, very flexible. All right, it's very flexible. Rates are extremely competitive in comparison to an FHA program. So it's just one of those things that helps out so many clients, right? Keeps their out-of-pocket expense at a minimum. And we can pair it with USDA renovation and a lot of fun things. Finance closing costs if there's enough value. Very cool program. And how this is going to help. So a little background on housing ratios, debt ratios. So there are two ratios on everything that we look at, right? There's a housing ratio and a total debt ratio. The housing ratio is comparing your gross monthly income versus the house payment only, okay? USDA on manual underwriting always required that you were at or below 29%. Really, it's like 28.99%, right? That was a requirement. If you're over and above that, no go, okay? So we had to keep that housing ratio in line. The total debt ratio is the back-end ratio. On manual underwriting, they would allow you to go to 41. That ratio takes into account the house payment, all your monthly debt obligations, credit cards, auto loans, student loans, personal loans, whatever, that monthly payment on those, versus the gross income, okay? Now, that total debt ratio has not changed in their eyes on the manual underwriting. It's still 41. We're specifically talking about the housing ratio, okay? Why this is so cool that they actually increased it from 29 to 34 is that's the ratio that's always hard to comply with, okay? It's a very restrictive ratio, and it kind of restricts the affordability piece on how much you can go out there and purchase compared to a lot of other programs. It's very difficult to fix it, right? So if you're in the process or you're buying a house right now and you're at a 28.9% on your housing ratio on a $100,000 purchase, for example, if your insurance came in $5 too high and it was over 29%, we're kind of stuck, right? The only way to really fix housing ratios is to decrease your house payment in a couple of ways, right? Insurance lower, rate lower, or buy less house, or you make more money, right, to fix that housing ratio. In comparison to the total debt ratio, if we kind of go over a little bit, we can fix it, right? We might be able to pay off a small credit card to get you under or what have you. There's some more wiggle room there. The housing ratio is just so fixed and finite, it was very, very, very difficult to comply with in all transactions, especially in today's market with high rates, high prices. It's very challenging. So let's get to this change. So it goes from 29% to 34%, or we'll be at 33.99%. So an example, if you were making $52,000 a year of income, okay, which is pretty normal in this area, okay, I'm using an assumption here, okay, using an assumption that we are using property taxes of $150 a month, and we're using insurance or homeowners insurance of $100 a month. So that individual making $52,000 a year to stay under the 29% ratio could have bought about $142,000. That's how much house they could afford to be at the maximum housing ratio using the old guideline. But effective August 5th is key. It's not tomorrow, all right? It's only a month away. So August 5th is based off your commitment date also, by the way, not your application date. So on August 5th, when this changes to 34%, that same borrower that could have bought $142,000 can now buy $175,000. That is a $33,000 swing using that specific scenario, okay, of $150 a month property taxes, $100 a month insurance. $33,000 swing in your affordability in regards to how much you can qualify using USDA financing. That is huge. Because we find a lot of borrowers that can be restricted by this ratio, And as you all know, this market has been very challenging, and homes are a little expensive, rates are a little high. So being able to find a home that qualifies for USDA financing at a lower price point can be a challenge. That extra $33,000 right there can be the difference between not finding a house at all in this market and finding a home that works just for you. So I found this as a great announcement, super excited about it. Can't wait to start working these ratios with all of our consumers while they're out there shopping, and we'll get that information updated and out to everybody. But I wanted to make that announcement. I'm sure all the other lenders have already heard about it, but a lot of our real estate partners and our borrowers included have not heard about this change. Now you have. So I hope that's good news for the industry, good news for our market, and we can help get some more buyers in play here. Now, again, this isn't going to be a one-size-fits-all, okay? Remember, we still got to deal with a total debt ratio, but a lot of times that housing ratio is the one that's the most restrictive. So I think it's going to help out a lot of buyers, a lot of consumers out there to get them in a better position to buy a house. Also, remember, that was based off that specific scenario, okay? So each property is going to be different. You might find that same $142,000 house that has taxes significantly less, so your purchasing power was already a little bit more. So take that into consideration. Call your lender, talk it out, and see if this can change your price point when you're out there shopping in the market. I hope this was helpful, guys. Remember, subscribe on YouTube. Check us out on Apple Podcasts and Spotify, and we'll catch you all next week.